trade wars, global recessions, markets spinning out of control, our dollar in free fall. Just about everyone you speak to will say today is the worst time to invest. But when fear reigns, like it is right now, that is exactly when the best opportunities come to light. We are in a golden moment right now, and those investors that understand this and can understand the history of how global recessions are actually positive for property investors will be one step ahead of everyone else. In this video, that's exactly what I'm going to show you. Let's go. So let's start by going through the last 30 or 40 years and try and work out what happens when the world goes bonkers like it is right now. I've got all the way back down to 1987. Wow, I went back a long time for this chart. I wasn't even born then. And what you can see here was this thing called the Black Monday, the share market crash. Now, anyone older than about 50 will probably remember this, and my old man tells me the story of, oh, when I was investing back then, there was this day where I lost a lot of money. This was that day, the Black Monday share market crash. But look what happened to property prices right afterwards. Bonkers. Over the period ahead, property prices went up by nearly double the period before Black Monday, up 28% in just a couple of years. Absolutely crazy. We've also had a few more recent examples of this. Think of the GFC. I was only in my teens then, and I even remember that property prices went up a lot. So, the GFC reigned in Australia, hit around February 2008, and property prices did fall for a year. At the time, you couldn't get a loan. You could barely get any funding. Credit dried up, and there was so much uncertainty. That played around for a year, and then after that, property prices went up so fast that the normal curve, like this, had to be like tilted up to go like this because property prices rose so fast. Up 15% in a matter of months shortly afterwards. And anyone who bought in and around 2009 will be sitting on a pretty penny just about everywhere right now. And then we have the most recent example that almost all property investors or budding property investors should know about. COVID. Property prices did begin to fall again. It was in the middle of an upward trajectory, and that got completely punctuated. We were in the middle of a little mini boom at the time. For those that remember, it was 2019. Interest rates were cut. The lending regulator said, go have some more money. Property prices began to rise. And then, COVID hit our shores and property prices began falling. What happened afterwards, though, was another mega boom, even bigger than the boom in 1987, up 33% nationally. And in some places, even more than that. So what am I showing you here? I'm showing you all of the periods where there was some crazy global type recession, some event that was outside our control, a very pivotal moment in the world's history, just like we are in right now. And all of our history and previous events show that property prices do fairly well in this environment. It also shows that sometimes, depending on what actually happened, for a little period of time, that property prices do not do well, that sales transactions do not do well, that the uncertainty makes everyone feel a little bit scared and they stop buying and selling too. And that little window of opportunity is right now. We don't even have that much data on it yet, but there is potential for you to be buying at today's prices, noting that there's changes in interest rates coming that will drive the next leg of the property cycle around Australia. So let's unpack exactly why property does well. In Australia, we have a rising population and we have a few triggers that the government can pull anytime the economy begins to slow a little bit too much. And Australia's been pulling these triggers a lot of the times to ensure that we don't go in a recession. One of those triggers is population. Every time we go into a little bit of a slowdown, Australia opens up its doors and says, "Come at me, world. Let's come to Australia. I want you to promote our economy." We've been doing that for a little while to manage our inflation crisis right now, and it's caused all sorts of controversy politically at the moment too. The other big mechanism that we have is cutting interest rates. And I've done a little other video on this specifically and my expectation that an interest rate with a 4 handle is coming very soon. This fall in interest rates means everyone has more money to spend, and more importantly, people can go and purchase a home at a higher price because they've got more money to play with, and that feeds through to higher property prices, especially in mortgage-sensitive locations like Sydney and Melbourne. And there's a third reason as well. It's a little bit of like this weird crowding out impact. All of this uncertainty and fear and that nervousness people feel, it's attached to asset classes that are a little bit more liquid than property. People feel scared investing in stocks, in crypto, in bonds, in all of these other markets, especially when there's so much volatility. And when they feel scared investing in these markets, they sometimes shift their money into something that feels a whole lot safer. And that is exactly why people invest in property, and it does fairly well during circumstances like this and often beats asset class performances in other sectors like shares and bonds at the time. It's just investors who invest in these markets are shifting that money away into the property market itself. So those are the main reasons why property does really well in times of craziness like we are in right now. Hey everyone, if you're still watching, could you do me a quick favor and hit that subscribe button so I can keep producing videos like this for you all? So I also want to capture out exactly what type of property does well. Property doing well is a little bit too general for you to go and work out what to do. You might be sitting here watching this and being like, yeah, it makes a little bit of sense. Maybe I should be in property. That's true. But then you go through it and be like, what does he mean? Property? Should I go buy the house next door? What should I be buying? What's going to do well? And this is also going to change fairly dramatically, especially given the type of circumstances we have at the moment. It is very specific. It is a specific economic circumstance that impacts different economies all across Australia differently. And that's something to be mindful of when you look at it too. So when I look at this chart, I'm looking at the history of Australian property prices over the last 5 years and different markets. And what I can see is Perth has shot the lights out, Adelaide has shot the lights out, Brisbane has shot the lights out. We've talked about that a lot, all up above 70%. And then there's another group of markets, Canberra, Hobart, Darwin, Sydney. They've all risen around 30% in the last 5 years, rising about 5% a year, compounded. Gets you to the performance of these markets. And then you have the laggard of Australia, Melbourne, only rising 9.3% over the last 5 years. And really, that all happened in a short time period in 2021. So, what I see here is something that is a function of higher interest rates, and I expect the absolute opposite to happen over the next few years. In fact, I'll go so far. I think Perth, Adelaide and Brisbane will come right back down to the pack and even potentially go to the bottom of it in some cases over a 5-year period. Meanwhile, these markets that are looking down here at the bottom, especially Melbourne, is going to go right up to the top, and Sydney, Darwin, etc. are going to do very well. So that's the first golden insight for you in terms of what type of property you should be buying. Buy the markets that have done poorly over the last 5 years. They have partly done poorly because interest rates have shot up so much over the past few years, and these markets are very interest rate sensitive, especially Melbourne and Sydney. With interest rates that are now crashing back down, the opposite is going to happen. More and more demand is going to filter into Melbourne and Sydney as a result, and I expect these two cities to go and top the charts over the next few years because there's more room to grow. In particular, Melbourne should do really, really well because it is so far behind and it represents value so much better than the other cities. Meanwhile, some of the other capitals like Sydney have an affordability problem there, which will limit the amount of growth that is actually possible in Sydney. And there's one final consideration to work out what type of property you should be looking at. And this one's a little bit of a surprise. When I look at this data set here, I am looking at the type of properties broken up by quartile. So you have the cheapest properties, you have the middle quartile properties, and then you have the expensive properties. Over the last few years, you can see it pretty clearly. There's been a pretty sharp slowdown in the most expensive properties. The reason why? Interest rates have gone really, really high, and people who live in those $2 million homes, they have bigger mortgages than those people who live in $500,000 homes. This goes against some old adage some people have, where it's like, you must buy premium properties. This little period tells us that is no longer true. Affordable properties have completely outperformed the more expensive properties, and you could see that over the past few years. And this is not something you'll hear everyone talk about. The reason why is all of the content providers across the platforms that you read and listen to nowadays, they're all effectively operating in a marketplace that is dominated by buying the cheaper properties, because there's more transactions that happen there and there's more people buying there, and effectively the people with big audiences are catering to this marketplace. Now, this marketplace is going to do less well than the more expensive properties over the next few years. So I'm expecting the top quartile to be the highest performing quartile in 2025, while the bottom quartile to go from the top to near the bottom of the rankings. So what's going to do well? I'm thinking Melbourne, expensive properties all across Australia, those with large mortgage balances, and those not exposed to the mining industry and markets that are likely to do quite poorly associated with the trade war itself. And finally, there's one last thing that everyone needs to be mindful of. We are operating in a period of uncertainty. This is how I prefaced the beginning of this video. When fear reigns, opportunities pop up. But there's a reason for having some fear too. It would be silly to just put your blinkers on and being like, hey, Ridham said, history tells us that it's all going to be okay, so let's go and start buying property. It isn't as simple as that. There is a reason to be fearful as well, and it's worth understanding what will actually drag the market down and mean that it's a little bit different this time versus other times in history. And the main thing to be mindful of is unemployment. Will there be a big unemployment problem here in Australia associated with all of this global panic that's going on and the global recession? Because if there is, it doesn't matter if they cut interest rates a fair bit and some people have more money in their pocket. It doesn't matter, because if they don't have a job or if there's significantly more unemployment, then they're not going to be able to get a mortgage or buy a house anyway. And on top of that, everyone who already has one who becomes unemployed is not going to be able to service their existing mortgage, and that creates a drag on the economy too. 2020 is not the right experience to use. The government saved us all. They came in and said, anyone who loses their job or shuts it down, you stay at home, we'll pay for it. That ain't going to happen this time. That's not how this type of crisis works. If we have China slowing down and economies all across Australia, different economies, losing their jobs as a result because they can't sell what they typically sell to China or to America or to anywhere in the world, and that slows the economy down, then unemployment is something to be very, very mindful of, because it is the underlying driver of property markets too. So that's the main concern point to be considered. And then there's a second one about credit conditions and financing conditions in general. I don't think this one is that much of a risk right now. A trade war and a global recession should not necessarily lead to some sort of debt problem or a debt crisis here in Australia, and it's unforeseen right now, so it's not really an issue to be too mindful of right now given the type of issue that is at play. That was the GFC. And this sort of crisis is very, very different. It's about an economic slowdown of major trading partners, not so much them having too much debt and not being able to repay it. So there's a lot to unpack here. But the key takeaways here are property prices typically do well. I expect them to do very well. And certain markets will do much better than others, and certain types of properties will do much better than others. This video sums it all up, and what is coming next in our range of videos is going through market by market and unpacking exactly how a trade war impacts different markets all across Australia to help you understand whether you should invest there or whether you should sell and get out of that market because of this new economic world we live in today.